Hello and welcome, everybody. This is the Quarterly Scouting Report. My name is Adam Koch. I'm President and Portfolio Manager at Libertas Wealth Management Group in Columbus, Ohio. And what we're going to do here is we're going to go through a bunch of different pictures and charts and things like that. And I promise to make it as simple as possible. I always do my very best. I understand that this stuff isn't always easy. But like I said, I'll do my very best to keep it simple and try to make this a really educational video because we've had a crazy quarter, the worst quarter for the Dow Jones Industrial Average in U.S. history. So let's go ahead and jump right into it. Before I get started here, the first thing I want to point out is some of the charts that I've used were part of a big all-day virtual conference that I was a part of with a bunch of friends of mine and that are kind of in the analyst world, portfolio management world. It was put on by JC Peretz of allstarcharts.com, and then also a lot of help from the people at the chart report. So if you're ever looking for a really, really great daily email that you get at the end of the day with wonderful charts, if you're a nerd like me, the chart report, go check them out on Twitter, check them out online. But anyway, some of these charts came from that event, and I'm going to make sure that I give credit to those people who did put those together. So first, just have to start with a quote here from my friend Art Hill. Stock market crashes are like taking your boat out in a hurricane. Either you better have a pretty incredible boat, or you better be a really good skipper. And the whole point here is that when we're in a downtrend, when the market is crashing and every time frame for the most part, especially the longer and intermediate term time frames are headed down, it is incredibly difficult to try and navigate the waters and try to find investments that are going up. So, if you're looking for investments, at least for me, if I'm looking for investments to buy, I'm looking here. I've got my crystal ball behind me, which doesn't work, obviously. Somebody got me that as a joke gift a long time ago. But so nobody has a crystal ball, but you probably want to be looking at investments that are in an uptrend. And for the most part, right now, there's just not too many of those. But anyway, it's a really, really tough time to be invested in stocks. So sometimes, as I like to say all the time, and when we're in a big, huge thunderstorm or a hurricane or a tornado or whatever you want to use as the analogy, sometimes the best place for our players to be is in the locker room. Sometimes the best place for our families to be in the basement, undercover. So a lot of us might have felt like this, this past couple days. I got this from my friend Andrew Thrasher at Thrasher Analytics, and kind of I don't know. As the saying goes, the market takes the escalator up and the elevator down, and I think we've definitely seen the elevator part of this analogy. Moving forward, another thing to keep in mind here, and this is really, really interesting to me anyhow, is that this was the fastest bear market in history. And by the way, for those of you who are new to my screencasts or new to my content, a bear market, whenever we talk about bear markets and bull markets, the reason they call them bear markets, which are down markets, is because bears attack with their claws from the top down, whereas bulls attack with their horns from the bottom up. So that's why they call them bull and bear markets. But anyway, this is when you look at this table here, you can go back to any year you want, 1896, 1987, Black Monday, 38 days before we saw a 20% decline. So a bear market is defined as a 20% drop from the top, and this time we did it in 19 days. When I say we, I mean the market went down, Dow Jones Industrial Average, 19 days it went down 20%, which, it doesn't matter what kind of strategy you have, it's extremely difficult to see that happen in such a short period of time. And when we talk about how bad things have been, one of the things that really is tough for me to see are statistics like this. I don't think anybody was ready for this. In fact, I don't think, obviously nobody predicted it, but I don't think anybody ever thought that we were going to see another market crash again, because for 11 years the market just kept going up. I mean, we didn't see a 20% decline for 11 years, and I think that what happens with investors is, our psychology, we're human, is we just get complacent and we forget. It's recency bias. We can't remember something that happened 2-3 years ago, let alone something that happened 11 years ago. So you can see here, looking at this pie chart, that very, very few people have any substantial savings sitting around in their accounts. And when you talk about 2, 3, 4, 5, 6 million, 7 million people filing for unemployment, this is scary stuff, and it's obviously really concerning. Another thing that I want to point out here is I've been, every once in a while I get emails, text messages from, friends, people on Twitter, social media, Instagram, Facebook, and what have you. And they'll say things like, well, hey, don't you think this thing's coming back because the market's, it's up, X percent, so if the market was up, say 17%, 20% this past couple weeks, is this the bottom? Is the market headed to new highs now? And I obviously don't know. Nobody knows. But the way I manage portfolios and the way I manage money is I invest with the trend. I'm a trend follower. So I always say I'm not a trend predictor. I'm a trend follower. So I have no idea what the market's going to do next week, next month. But what I do know is that we are in a downtrend on the long-term time frame, intermediate-term time frame, and depending on what week you're looking at in the stock market right now, it could be up, it could be down. But this is the 2007, 8, and 9 market crash where the market went down 57.8% from top to bottom. And what I want you to point out here, I want you to pay attention to, is that market goes down here 18.6%. And then in a matter of a couple months, it bounces, goes up 12. Now that might trick investors into thinking that, well, the correction's over. In this case, it was just a correction so far. But then it goes down from here, it goes down 37%. And then people think, okay, well, I guess it's over now. It can't go any lower than this, right? And it bounces 11.6%. Then it goes down 15.4%, and it bounces 18.5%. And they think, well, this must be the bottom. We're seeing some, maybe equal highs, higher highs here, but then all of a sudden it heads down 25.2%. And then it's got to be the bottom, right? You can't go any lower than this because it goes up 24.2%. But still, we're not at the bottom yet because, we have no idea what the future holds if we're sitting right here at the peak of this little short-term bounce. And then it goes down 25.2% before finally hitting in the low in March of 2009. So the next one I want to show you is very similar. This is 2000, 2001, and 2002. So this is the dot-com bubble. Here, again, 11.2% drop, 12.1% rebound, no big deal. The market's fine. Nobody has any clue what's going on. Everything's going to be okay. Y2K is past us, and it wasn't that big of a deal after all. And then all of a sudden, it goes down 27.5%. Well, again, you start hearing the things out there that, people saying, oh, well, it can't go any lower. Then it bounces 19%. See, I told you it couldn't go any lower. And then it's down 26.4%. Well, if it went down again, it can't go down any further. I mean, if it already went down twice, right, it's got to go up from here. And sure enough, it goes up 21.4%. Great. We're off to the races. The coast is clear, and there's no reason to have any worries anymore, right? But no. Instead, it goes from being up 21.4 to down 32. And then over the course of the next 9 months, it goes up 20.7, down 19.3, up 20.9, down 14.5, we'll call it, before finally bottoming in what kind of a triple bottom fashion here. So I'll show you one more. This is the Great Depression. And what I want you to do is just count them. I mean, this is a really, really long. Obviously, the Great Depression was ridiculously long and drawn out. But you have 1, 2, 3, 4, 5, 6 bounces of 48%, 15%, 30%, 29%, 33%, call it 34%, and 23% bounces. You don't see these kinds of rallies, or in other words, you don't see these kinds of swift moves upward in a bull market. Bull markets are kind of healthy and steady, and there's corrections along the way, but they're typically pretty muted, 5% pullbacks a few times a year, maybe 8%. Once a year, maybe you get 11 to 14% correction on average. But when you're in a downtrend, when you're in the midst of a market crash and all the trends are down, what you typically tend to see is, some people call them dead cat bounces, but you tend to see these big influxes of money into the market. And there's a number of reasons why that could be. A friend of mine, Andrew Thrasher, I mentioned him earlier. We were talking about this a few weeks ago. And one of the possible explanations, if you care to have one, is that perhaps maybe it has something to do with quarterly rebalancing. And what I mean by that is, you've got mutual funds, hedge funds, pension funds. You've got all these institutional money managers who, when the market started at the beginning of this year, let's just say they had a model, and there's several models out there. You could have 60-40, 75-25, you can have an 80-20 model, but let's just say January 2nd, which was the first day of the year for the stock market, all of their models were at their target allocation at about 75% stocks, 25% bonds. Well, when you have a market crash that went as fast as this one did, which again, fastest market crash in history, what ends up happening, and these aren't real numbers, by the way, I totally made this up, but what ends up happening is, and this is what Andrew and I were talking about, is you end up with this huge kind of imbalance between stocks and bonds, and in this case, in only 3 months. So now instead of being 75% stocks and 25% bonds, now we're 53% stocks, 47% bonds. So what has to happen at these mutual funds, pension funds, and these institutions? Well, they have to move that money back to target. So they have to sell bonds, and then they have to buy stocks. And then on top of that, we're not talking about small money here. We're talking about institutional money, huge portfolios. So it can take them days to sell the bonds that they want to sell and then buy into the stocks that they want to buy into in order to bring the portfolios back to target. And that's what can cause a 17, 18, 19, 20% rally in a matter of days or weeks for that matter. So again, not the explanation, but an explanation of what could have happened. So let's change gears here real quick. I want to talk about some of the scenarios that I think could play out from here in the market, and there's a few of them. The first one is Vbottom. This is what we saw in 2018 fourth quarter and the first quarter of 2019. They're extremely rare unless you're talking about a really, really short-term time frame, which that's not even, in my opinion, a stock market bottom anyway. We're not talking about short-term bottoms here. We're talking about market crashes. So a V-bottom is it's simply when the market kind of heads down and then you get this kind of moment of capitulation and then it just soars to the sky. And what happened back here in fourth quarter of 2018 was the Federal Reserve was raising rates and we didn't have any stimulus, of course. And I think investors were getting a little freaked out. So you start to see sellers come in, and obviously the way the market works is if there's more sellers than buyers, then price must fall. And if there's more buying pressure than selling pressure, then prices must rise. So on the Christmas Eve here, when the market bottomed on Christmas Eve of 2018, shortly thereafter, Jerome Powell, the Federal Reserve, came on TV and radio and said, you know what, not only am I going to stop raising rates, but I'm going to start lowering them, 4 to 6 times this coming year. And that just set the market soaring. So that's a news-driven event. I think this is probably a very unlikely scenario. I think we all know, it doesn't take a rocket scientist to know that we're living in very interesting times right now. And I think that it's going to take a lot of time to kind of work our way through this. So the second scenario, which I'm just calling scenario 2, would be a W bottom. This is where these are more common. You have a market goes down and then it bounces, and then after the buyers are done, the short-term buyers, they step out, which sends prices back down again. And then once we see what we call a retest of this low, so here's the first low, here's the second longer-term low, that's when we want to see, okay, are the long-term buyers stepping back in and pushing prices higher again? And in this case, back in 2015-16, they did. The problem, of course, there is not only is this one huge W bottom over the course of, we'll call it, 15, 16 months, but you can see here, if you pay attention really close, there's 2 W's here. So you've got one that bottoms in August of 2015, bounces back down in October, and then you've got another one here in early 2016. So here's 2016 February, it bounces, and then you get a double bottom, and then we're off to the races. But it took a really long time for this one to take place. So a W bottom, I think, would probably be a little bit more realistic. I think it's probably a higher possibility outcome than a V bottom. A third possibility is what we saw back in 1987 with Black Monday. Market goes down about 33% and change in a very, very fast waterfall fashion, just like we've kind of seen recently. Not quite as bad in terms of a one-day drop, but it did go down very fast, obviously. But you can see here, you could almost see a little W in here, but basically it went down, and then it kind of crept along, and I think my friend Ari Wald, he called it a whimper. So, you got a waterfall drop, and then you got a kind of a whimper sideways. So that could be a possibility, and I think that's definitely on the table. The next possibility here would be another leg down, and so here we have, this is 2001, 2002. So here's peak of the market in 2000, and then you get this drop of 27.5% off the top. then the market bounces just like it did this last couple weeks, and it was up here 19%. That's pretty close to what just happened recently. And then you kind of get this maybe potentially retest right here of this first low, but instead of it retesting and forming a W bottom and heading higher, instead it breaks through that floor of potential support, and it creates a new low of down in this case from this peak to this bottom here, a drop of 26.4%. And then again, you get this kind of rally, this bounce off the low. And what you're trying to look for, obviously, higher highs and higher lows are uptrends. Lower lows and lower highs are downtrends. And what we want to see, obviously, is higher lows and then obviously higher highs. But in this case, we get another lower high, and this just can't seem to get above these highs here, and it heads lower again and breaks through the floor another time. So this could be definitely a possible scenario, especially when you consider the coronavirus, when you consider the number of people that are unemployed right now and that potentially may become unemployed in the near future. So this is definitely a scenario I think we need to at least consider. I'm not predicting the market's going to go down. I can't predict it, but I think we need to be prepared for it, which is why we believe that cash or money market or being on the sidelines is an extremely smart place to be at a time like this. Again, when there's a hurricane or tornado, whatever you want to call it, it's extremely hard to navigate these waters and be a hero. Speaking of Ari Wald, I mentioned Ari earlier, and Ari, he's the technical head of technical analysis at Oppenheimer, and he came on Chart Summit and put this chart up, and I thought it was really interesting. So this is an overlay. You can see the dark black line is 2020, the blue line is 1987, the outcome or fallout that took place after the Black Monday drop, which you can see again, that's that kind of whimper sideways or that L bottom, and then this dotted line, dash line, is 2008 and kind of how things played out from there. So that's, I think, just kind of a really neat visual that gives you a good idea of maybe two possibilities that could occur from here. This is a chart. This next one is one that I've been putting on my quarterly scouting reports, my halftime reports, market outlooks, articles that I've written. I've been pulling this one up and tracking it for a while now because I do think that there's some significance here to the fact that in the top pane of this chart right here, when unemployment bottoms at its final low, you tend to see sometime within 9 to 12 months a top in the stock market, and then a market crash thereafter. So this is 2000, the bottom in unemployment, which corresponded within a handful of months of the top before the dot-com bubble burst. And then right here, this is the final bottom in 2007 in unemployment before, again, handful of months before the market peaked in October of 2007, and we saw, the 57-58% drop in that market crash. So here we are today with unemployment at its lowest it had been in 20 years. And now we've got this huge surge in unemployment, obviously, as a result of the coronavirus, the stay-at-home and orders and lockdowns and whatnot. So definitely something to keep in mind, just more evidence that we got to be really, really careful here. And speaking about history, I thought this was just an interesting way of looking at things. So this down here on the bottom left is the bottom of the stock market back in 2009 in March. And then you see you got this 11-year bull market, and then you get the peak, obviously, here in February, just 2 months ago now at this point. So in 1987, you can see how far the drop was, which is right about where we are right now, or where we were, I should say. If this market were to continue lower, the next stop based on history would be the 2000-2002 lows, which is a drop 47%. The next year would be 1973-74. The market peaked and went down 48.3, and then 2007, 8, and 9, which is obviously on this chart, you're looking at it, was down 57.8%. So again, this isn't a prediction. I'm not saying that this is where we're going to go. I don't know what the market's going to do. I'm analyzing internals, kind of like a doctor, a doctor or a nurse analyzes their patient. We're using stethoscopes and blood pressure monitors and EKGs and things like that. Doctors use to diagnose their patients, and without those tools, it'd be pretty tough to do their job. Well, in our world, in my world, I need to look at things like market internals, like the percentage of stocks above their 200-day moving average, above their 50-day moving average, the new 52-week highs and lows. So the number of stocks that are hitting highs and lows, relative strength, things of that nature. So it's not just about what the stock's doing or what the stock market's doing on the chart. It's about what's going on inside. Sometimes a patient can look really healthy on the outside, but there's something going on inside that isn't so healthy and might spell disaster. So that's what we got to be paying attention to here. And this chart is one that I've put in many articles and videos in the past as well. This is just an education called an Investments 101 on sequence of returns. A big mistake I think many people make is they think that just because they lost 30%, if they make 30%, then they're back to even, and that's not the case. If you lose 10%, it only takes 11% to get back where you started. If you lose 20%, it only takes a 25% gain to get back to where you started. Still not that big a deal. But when you start losing 30%, 40%, 50% of your money, you have $1 million and it's worth $500,000. It takes 100% to get back to even. So just something to keep in mind. Another thing I think that you got to be on the lookout for is there's a lot of mutual fund propaganda, a lot of a lot of statistics out there that have I would say that they're filled with conflicts of interest. And what I mean by that is when people say that you should stay in the market all the time, keep in mind who's giving you that advice. If I own a mutual fund or an ETF and I sell that mutual fund or ETF, do they get paid anymore? And of course the answer is no. So of course they want us to buy and hold. But this is something from Michael Batnick at Ritholtz Wealth, and I thought this was just a wonderful visual. And you see these statistics come out that say, oh, well, if you miss the best days in the market, then your performance goes down dramatically. And that's true. And I'm going to go back and forth real quick here. So if you have $1 invested in the stock market back in 1993, that dollar, if you miss the best 25 days over that time period, you've only grown that dollar to $2, which on the surface makes you think, man, I really don't want to miss out on the best days, the best 25 days. And who can, right? Because you can't. It's impossible. But what the statistics actually say, and there was a guy named Paul Geyer who I believe is retired now, but he did a research study back in the 2000s, and then I did a redux on it back in 2015 with Heather Adkins, someone who used to work with us here. And what we found was that the biggest up days were also within days. Typically, about 80% of them were within days of the biggest down days. In other words, the biggest up days or the best days in the market tend to happen when the market is crashing because we have high volatility. So if you consider the fact that the biggest up days happen really close to the biggest down days in most cases, then what that tells you is that the biggest up and down days happen when volatility is high. And when is volatility high? Volatility is high when the market's in a downtrend. So as you can see on this chart here that Michael did, you can see that a good portion, now obviously not these first few here on the left, but a good portion of these biggest up days in the market occurred when the market was underneath its 200-day moving average. So in other words, it was when it was in a downtrend. You can see here's a bunch more over here on the right in the most recent market that we're going through right now. So if I go back to that historical chart here, you can see that, yes, you're absolutely right. The people that put out the statistics that say if you miss the best 25 days in the market, you won't grow your money very much. $1 grows to $2, 100% return from 1993 to 2020. No big deal, right? But if you miss both the best and worst days, in other words, if you just avoid the volatility and if you stay out of the market when it's in a downtrend, it's actually up more than you would make just by buying and holding and staying diversified. In this case, we're just looking at the S&P 500, but missing the best and worst days, in other words, avoiding volatility, avoiding downtrends, ends up working out better in the end. All right, so what now, right? The market's gone down quite a bit. We're in a downtrend. So how long is it going to take to get out of this bear market that we're in, out of this market crash? And here is Ryan Dietrich, again, a great table that he put together. And what you're seeing is the decline in months, so the length of the bear market in months here in the first column. So you can see the average decline was about 12 months. If there was a recession, the average was 18 months. And if there wasn't a recession, it was only 7. So that kind of gives you some numbers to kind of play with there. The average decline was 30, and this is going back to the 1950s. And then the average decline was 37% if we went into a recession, 24% if we did not have a recession. Now, obviously, those are just averages. One of my favorite nerd jokes is all about the guy who drowned in a river that was an average of 4 feet deep. Just because it's an average of 4 feet deep doesn't mean you don't have 49% drops, 56% drops, 48% drops back in the 70s. So, but the length of recovery, How long is it going to take to get out of this thing? Well, who knows, right? We have no idea. Some of them, the really short ones, like the 90s, the 1998 drop, only took a few months. But when you look at the averages of all these numbers, the average recovery takes about 20 months. If we don't have a recession, then the average recovery is about 10 months is all. If we do go into recession, which I think it's pretty obvious we will, then I think it could be a longer. But at the same time, and let me just throw my opinion in here, I do think that if this crash keeps getting worse and if it's really, really bad, I do think that we will probably see a really, really strong rebound that's stronger than most. But at the same time, my opinion is still such that the market is in a downtrend, and my opinion is that I think that we still have a lot of work to do before we're going to see a recovery anytime in the next few months. I just don't know how that could happen. Obviously, if it did, then we'd be getting back into the stock market. But until that happens, until I start to see signs, like I mentioned, the EKG of the market, starts to show me signs that it's getting healthy inside, stocks are going to be a no touch. And this is kind of a fun continuum of investor psychology here. And what you're looking at is just, again, the different phases that the market goes through. So when the market peaks, let's just call this February 19th, the market peak here. And then this is the first waterfall decline that we saw going into the bounce. And let's just say this is the bounce. Obviously, this is not a real stock market chart. This is not a prediction, but this is kind of what happens in normal market crashes. Is people feel like they've returned. The things have returned to normal. Everything's going to be fine, and the coast is clear. And then when we break below that low, if we break below that low that took place a couple weeks ago, then that's where the things get really scary. And obviously, more and more people start hitting the sell button. And the more people, obviously, again, like I said earlier, the more selling pressure we have, the worse things get and the more prices go down. So who knows what's going to happen here. But at the end of the day, there's going to be a lot of change, I think. A lot of people are going to be working at home, not just during this lockdown, during the stay-at-home order, but probably afterwards when it's over with. I think that after this hurricane, the world is going to probably, when we come back to our house after the hurricane, so to speak, our life, I think it's going to be a little bit different than the one we left. Again, I think it's going to take time, but we are going to recover. And I think the great thing is there's going to be some huge, wonderful opportunities to participate in the next new bull market when the market starts to go back into an uptrend and when we start to see a long-term reversal in the bottom. The hard part, of course, is patience. We have to be patient. So patience is the key here. All right, one more thing here before I go. Just wanted to share with you, we're relaunching our podcast, which we're calling the Cash Podcast, which stands for Creating Affluence, Success, and Happiness. So we're going to talk about all kinds of things on this podcast, from general investment education to retirement planning, financial planning, tax planning, insurance planning, college savings. We're going to talk to CEOs of companies, executives, VPs. I'm going to interview different people and kind of get different people's takes on different things having to do with just business or life or success. And our first one that we have coming out here, hopefully this weekend, so hopefully I'm able to get it wrapped up, is actually an interview with Trent Dunlap, who is the vice president at HR Butler, one of the top payroll companies and HR and benefits companies here in Central Ohio. And while our doctors and nurses have a front row seat to the virus and what's going on from a healthcare standpoint, what Trent is going to talk to us about is the front row seat to the business environment. Obviously, businesses that pay employees have to pay them through payroll, right? So he's got a real good perspective on what's been going on in the business market, and I think you'll find that really interesting. But we'll be launching that podcast here, like I said, hopefully this weekend, and hopefully start doing that every week from here on going forward. So last but not least, thank you so much for joining us. If you have any questions at all, please feel free to email me personally. You can email us at info@libertaswealth.com. You can follow our company, Libertas Wealth Management Group, on Twitter at LibertasWM. You can follow me on Twitter at Adam Koch. You can follow me on Instagram at Financial Surgeon. Or you can follow us on Facebook at www.facebook.com/Libertas Wealth. So thank you again so much for joining us today. I hope that you have a wonderful weekend and that your spring and summer turn out to be a whole lot more exciting than what we saw this first quarter. But make the best of what this coronavirus stay-at-home order has to offer. One of our clients suggested that we go camping either inside or outside, whether it be with making tents with blankets. I think it's a great idea, but think cup half full here. Try to keep being positive. We are going to get out of this and everything's going to be just fine. So thanks so much for your time, and we'll see you next time.